Welcome to the debate. Imagine you are building a business where like a single millimeter of error or a tiny fluctuation in pressure means your flagship product literally explodes in midair.
Right, a total disaster.
Exactly. Now imagine taking that business and trying to convince Wall Street, a place that absolutely hates unpredictability, to fund it. Today, we are looking at Rocket Lab, ticker symbol RKLB, through the lens of a public market investor.
And the central question is really, are we looking at a generational space leader that's built this brilliant, durable moat? Or, are we just looking at a hyper-capital-intensive hardware manufacturer operating in, honestly, the most precarious competitive environment on Earth?
That tension is exactly why this company is so fascinating to underwrite. Because when you look at a traditional company, the diagnostic landscape is usually pretty clean. You look at the balance sheet, you check the cash flows, and it's basically a binary outcome.
Yeah, it's either profitable or it isn't. But in the new space economy, and specifically with Rocket Lab, that standard financial X-ray machine gets really blurry. We are looking at a company with an undeniable world-class engineering pedigree, but one that has historically really struggled to meet its own financial projections.
Which is the core of our discussion today. We've spent the past few weeks tearing down Rocket Lab's SEC filings, their earnings transcripts stretching all the way from their SPAC debut in 2021 through the recent Q1 2026 reports, plus their Investor Day presentations.
There is definitely a lot of material to go through.
Oh, tons. And I look at this body of evidence, and I see a company that has successfully executed a masterful strategic pivot. They went from being a niche rocket builder to an end-to-end space systems integrator with exceptional capital allocation.
Well, I look at that exact same body of evidence and see massive structural risk. I see a company whose timeline to actual sustainable free cash flow just keeps sliding to the right. And more importantly, they're stepping out of a market where they have a comfortable lead right into the crosshairs of SpaceX with their new Neutron rocket program.
Let's start by looking backward for just a minute, because how a management team navigated their past is, the best predictor of how they'll handle the future. If you rewind to the early 2020s, the big debate among analysts was the total addressable market, or TAM, for small launch vehicles.
Right. The skeptics predicted that small launch was just a dead end.
Exactly. They said you couldn't make money launching tiny rockets. And for almost everyone else, the bears were totally right. Astra went private for pennies on the dollar. Virgin Orbit went completely bankrupt. It was an absolute bloodbath in the small launch sector.
It was a complete bloodbath, yeah.
Right. But Rocket Lab didn't just survive that extinction event. They dominated it. They operationalized the Electron rocket so reliably that they actually commanded immense pricing power. A few years ago, an Electron launch was a roughly $5 million. Today, they're charging $8.2 million.
Which is a huge jump.
Over 60%. In a market where everyone else was dying, they raised their prices and kept their manifest completely full. Doesn't surviving a sector-wide collapse and establishing a monopoly-like position prove that management knows exactly what they're doing?
I have to stop you there, because surviving an unprofitable sector doesn't automatically make you a great investment. Yes, they survived the small launch bloodbath. But a monopoly in a tiny, capital-draining market just makes you the king of a barren island.
That's a bit harsh, don't you think?
As public market investors, we aren't buying survival trophies. We are buying future cash flows. Let's look at management's historical track record of forecasting those cash flows. Go back to their 2021 SPAC S4 presentation.
Well, the SPAC era was a massive anomaly for the whole market, though.
Sure, it was. But the S4 is the fundamental document they used to sell this company to the public markets. In that presentation, management aggressively projected that they would achieve positive EBITDA by 2023 and that they would be entirely cash flow positive by 2024.
And obviously the timeline slipped.
It didn't just slip. Look at reality. We just saw the Q4 2025 and Q1 2026 earnings. They are still reporting negative normalized earnings per share, specifically negative 2 cents in Q1 2026. The baseline financial underwriting was just fundamentally flawed.
I see why you think that, but let me give you a different perspective. If we look at the direction of error, the bears predicted small launch was a dead end that would never sustain a business. Rocket Lab proved them wrong by surviving and raising prices.
But there were early warning signs about their financial forecasting. If you dig into their 2021 10K, they revealed material weaknesses in their internal controls over financial reporting, specifically related to ASC 606 revenue recognition.
Let's pause and unpack that for a second, because ASC 606 sounds like deep accounting jargon. Essentially, that rule dictates how a company gets to count the money they make on long-term projects, right?
Exactly.
So, if you're building a satellite for 3 years, do you claim the revenue slowly piece by piece or all at once when it flies?
It's percentage of completion accounting. In the aerospace industry, where building a system takes years, but launching it takes minutes, getting that accounting wrong is a massive red flag.
But that was years ago.
It signaled early on that this is a company that excels at the physics of rocketry, but really struggles with the mechanics of financial controls. If their baseline underwriting for the core Electron business missed the mark by years, why on earth should an investor trust their financial underwriting for Neutron, which is a billion-dollar rocket program?
Because you're isolating their initial SPAC projections and ignoring the massive, highly successful pivot they made immediately afterward. They realized the small launch TAM wasn't enough to sustain a massive valuation. So what did? They didn't just keep building Electrons.
They bought a bunch of companies.
They evolved. Today, space systems, not rockets, account for 70% of their revenue. They hit over $200 million in Q1 2026 alone, just from the space systems division. These were highly disciplined strategic acquisitions.
I mean, discipline is debatable when you look at the capital required to integrate them.
But they bought companies like SolarAero for solar panels, Sinclair for reaction wheels, and ASI for flight software. And here's why that matters. It creates a mechanism called margin stacking. Think of margin stacking like a restaurant.
Okay, I'm listening.
If a restaurant has to buy its ingredients from a middleman, rent its delivery trucks, and lease its kitchen equipment, its profit margins are razor thin. But if the restaurant owns the farm, owns the trucks, and builds its own ovens, they capture the profit at every single step of the chain.
Right, vertical integration. I understand the theory of margin stacking.
Exactly. Rocket Lab isn't just launching other people's satellites anymore. When they won the $515 million Space Development Agency, or SDA, Beta Award, they were selected as the prime contractor to build 18 satellites.
Which is impressive engineering, I'll admit.
Right, because they are building the solar panels, the separation systems, the star trackers, the software, and then they are launching it. They capture margin at 5 or 6 different levels of the value chain. That internal cost synergy is the bridge to profitability.
It's a beautiful concept on a spreadsheet. But again, where's the bottom line? We are still looking at negative EPS. Integrating those companies takes massive amounts of capital and time.
Sure, integration takes time.
But let's say I concede the space systems argument for a minute. Let's say that business is perfectly sound. That engineering success doesn't matter if the bank account runs dry before they finish their next massive project. Which brings us to the core of the current debate, the Neutron rocket.
Which is the logical next step for their launch business.
It's not a step, it's a completely different sport. By developing Neutron, which is a medium-class launch vehicle, Rocket Lab is leaving the relatively uncontested small launch market.
Where they basically only fight the Northrop Minotaur?
Exactly, which is incredibly expensive and mostly flies legacy government payloads. With Neutron, they are entering the exact weight class dominated by SpaceX's highly reliable, heavily reused Falcon 9 fleet. This is what investors are agonizing over right now. Can the market actually support 2 highly profitable players in the specific payload class?
It absolutely can, because you are entirely discounting the structural dynamics of the government launch market. The Department of Defense, NASA, and the Space Development Agency do not want to be entirely reliant on Elon Musk's ecosystem.
They might not want to be.
Having a single point of failure for national security payloads is totally unacceptable to the Pentagon. They are actively, desperately seeking to cultivate a secondary supplier.
But SpaceX has fundamentally changed the economics of this payload class. They have internalized demand through Starlink. Because SpaceX is constantly launching their own Starlink satellites, they can keep their factory humming and iterate on reusability at a pace no one else can match.
Starlink is a unique advantage, sure.
It's an overwhelming advantage. They can absorb early launch failures or margin compression because Starlink subsidizes it. Rocket Lab doesn't have a captive mega constellation to absorb those costs. The bullish variant perception that Neutron will seamlessly take market share from SpaceX without a brutal price war just ignores economic reality.
You're framing Rocket Lab as a direct competitor to SpaceX's entire business model. But look at the commercial market. Commercial constellation builders, think Amazon's Cooper or European telecom providers, also desperately want an alternative.
Because they don't want to fund their rival.
Exactly. If you are building a communications constellation, SpaceX is a direct competitor to your business. Why would you want to hand your launch revenue to your biggest rival? These companies want a strategic supplier, not a strategic competitor. Rocket Lab is positioning itself as the neutral merchant provider.
Being a neutral provider only matters if your rocket actually flies and, if it flies profitably. Reusability of a medium-class rocket is an exponentially harder physics and financial problem than occasionally catching a small electron booster.
The management team has been incredibly forthcoming about the technical challenges of the Archimedes engine that will power Neutron, though.
Have they?
Yes, absolutely. If you read the 2024 and 2025 earnings transcripts, CEO Peter Beck and the engineering team offer extreme detail on the testing hurdles. They aren't hiding the ball.
Okay. I'll grant you that their technical disclosure integrity is excellent today. They are honest about the engineering realities. But let's map that to capital allocation. Let's look at the $1 billion at-the-market, or ATM, offering they implemented in September 2025.
I know exactly where you're going with this.
For listeners who might not track financial instruments, an ATM facility basically gives the company the right to create and sell up to $1 billion in new shares into the open market whenever they want. To the bears, this is a massive red flag.
It sounds scary, but it's standard practice.
It is a massive potential dilution overhang for existing shareholders. It suggests that the Neutron development program is draining capital far faster than anticipated. It completely contradicts the narrative that the core Electron and space systems businesses are throwing off enough cash to self-fund growth.
That's one way to look at it, but think of it as a war chest.
If the baseline business was truly self-sustaining, you wouldn't need a $1 billion lifeline waiting in the wings, right as your CFO, Adam Spice, warns that early Neutron flights will likely have negative gross margins.
I see why the ATM looks like a defensive move, but think about how this management team actually deploys capital. Look at their M&A track record, which is arguably the most disciplined in the entire aerospace sector.
Disciplined?
Yes, let's use your own earlier example, the Virgin Orbit bankruptcy. When Virgin Orbit went under, Rocket Lab bought their manufacturing assets in Long Beach. They paid $16.1 million for roughly $100 million in value.
They got a good deal on the equipment.
They got $80 million in specialized aerospace equipment and $20 million in leasehold improvements. They bought an entire, fully operational rocket factory for the price of a luxury condo in New York.
Buying distressed assets for pennies on the dollar is a great tactical move. I won't deny that.
But it's more than tactical. It's their entire strategy right now. In a high-interest rate environment, private space startups are starved for cash. They are going under left and right. Rocket Lab is positioning itself as the apex predator in the space supply chain.
Apex predator is a strong term.
But it fits. That $1 billion ATM isn't a lifeline because they're bleeding out. It's dry powder. It guarantees stability against U.S. government budget shutdowns, which happen constantly, and lets them aggressively buy up choke points in the supply chain the minute a smaller company defaults.
Opportunistic capital allocation doesn't shield you from the fundamental physics of your primary growth engine, though. Sure, buying scrap metal and factory floor space for pennies is fantastic, but it doesn't solve the fact that qualifying the Archimedes engine requires testing ascent and descent profiles simultaneously.
Which they're actively doing.
It doesn't solve the fact that every time they put a Neutron on the pad in the next 12 to 24 months, it is a massive financial risk.
Which brings us to the actual catalysts. Over the next year or two, what resolves this debate?
Well, the consensus currently sits right on a knife's edge. Everyone is waiting for those first Neutron flights. As I mentioned, CFO Adam Spice was very explicit that early Neutron flights will hurt their margins as they learn to operationalize reusability.
Right. That's just the reality of testing.
The probability of the bears being proven right hinges precisely on this window. If there are severe schedule slips with Archimedes, or if the margin compression from early neutron flights bleeds the balance sheet more than expected, they will have to tap that $1 billion ATM. Equity holders will be diluted. That is the specific evidence we are watching for.
And the strongest version of the bull argument looks at exactly that same 12 to 24-month window, but focuses on the space systems backlog. Every time they launch a neutron rocket, yes, the launch margin might be tight initially.
Very tight.
But if that rocket is carrying their own space systems hardware like the satellites for the Globalstar contract or the SDA, the margin stacking we talked about earlier will absorb those early launch costs. The evidence we've seen from their gross margins expanding in the space systems segment over the last year proves this model works.
Assuming the integration continues smoothly.
They aren't just an engineering firm rolling the dice on a rocket. They're a prime contractor with a massive backlog of government work to cushion the blow. Just look at their Mars sample return bid.
The NASA bid, right.
Right. NASA initially projected that returning samples from Mars would cost $11 billion and happen in the 2040s. Rocket Lab submitted a bid for under $4 billion, offering a return timeline in the early 2030s.
It's an audacious bid, I'll give them that.
Whether they win that exact contract or not, the fact that they are credible bidders at that level proves the U.S. government views them as a Tier 1 prime contractor. That government TAM is the durable moat.
But being a credible bidder is great for the resume. Winning the bid and executing it profitably is what actually drives the stock price. And we are still, fundamentally, talking about profitability in the future tense.
Just like during the SPAC era, you mean?
Exactly. Just as we were in the 2021 SPAC presentation. Where a debate is genuinely unresolved, we have to maintain intellectual honesty and admit it. We simply do not know if Neutron can achieve the target unit economics of Electron, and we don't know if they can avoid a price war with SpaceX.
That's a totally fair point. The management team is asking investors to look past current negative earnings and underwrite a highly complex future.
The balance of evidence suggests that while they are incredibly honest about engineering realities today, their financial forecasting is systemically skewed overly optimistic. They are fighting gravity in more than one way.
So if we pull back and look at the variant perception here, the public markets routinely misunderstand Rocket Lab as just a, rocket company, constantly playing catch up to Elon Musk. But if you look at the financials in the backlog, they really have evolved into an end-to-end space systems integrator.
They definitely have the system's backlog.
And they have a proven ability to squeeze massive value out of distressed assets, execute on complex government contracts, and survive industry-wide shakeouts that literally bankrupted their peers. They've established themselves as the viable merchant alternative to SpaceX in the eyes of the U.S. government.
And the reality check to that perception is that space remains a hyper-capital-intensive industry where hardware is just brutally unforgiving. The timeline to true sustainable free cash flow keeps moving to the right.
Which is the big risk.
The looming battle for medium launch market share is an existential financial risk. The potential dilution from their ATM casts a long shadow over equity returns. The technical execution is truly exceptional, but the financial realities of the space economy are very sobering.
We certainly have clear areas of convergence, though. The engineering execution and their survival through the small launch shakeout is objectively impressive. The management team has unparalleled operational credibility when it comes to delivering on hardware.
Absolutely. No one is doubting Peter Beck's engineering chops.
But the debate fractures around the ultimate profitability timeline of Neutron and whether the margin stacking from space systems can actually offset the capital drain of medium launch development.
And the ultimate arbiter won't be our discussion today. It will be Neutron's actual margin profile over the next 12 to 24 months. As the old small launch TAM debate fades into history, the Neutron unit economics debate takes center stage.
There is certainly much more nuance to explore in the SEC filings regarding how they account for these massive upcoming expenses.
Investors really need to dig into those 10Ks for themselves.
It really brings us back to where we started. When you look at Rocket Lab, you aren't getting a simple black and white financial picture. We're staring at a remarkably complex diagnostic image, one where brilliant engineering and visionary strategy overlap with delayed cash flows and massive structural risks.
It's a high-stakes bet.
It really is. The question you have to ask yourself as a public market investor is this. In a genuinely murky financial landscape, do you trust the surgeon's hands enough to bet on the outcome?